Welcome back to the CRE Spotlight. We have a wonderful guest, Mordy. And Mordy, why don't you tell our audience about yourself and what you do?
Hi, first of all, Andrew, thank you for the opportunity for having me on. Um, it's really, really special, and I'm listening to your podcast, and a lot of great guests bringing great value. So I'm pretty honored to be among them here.
Thank you.
I, yeah, I right now I work for Meridian Capital Group, which is the largest, probably of the largest, if not the largest, commercial mortgage brokerage in the country right now. Just to give you an idea of what we've done this year, we closed $60 billion in loans in the commercial real estate space. That's 4,000 transactions, 300 lenders. That's just this year alone. Meridian Capital's been around since 1991, I believe. And our main office is located in Manhattan, in New York City. And I work in the Chicago branch. There's a branch in California and Florida and in Ohio. I think there's another branch in Texas, but I'm not sure. We have over 300 people working at the company, and there's a tremendous amount of value that we bring for people who are in the commercial space, who are looking to either finance property or refinance a property. And there's a lot of experience amongst our whole entire team, people who have been doing this for a very, very, very long time. So that's what I'm doing right now. In addition to that, obviously, I'm a pretty beginning in the investing phase of things. I closed my first property in June.
Congratulations.
Yeah, I closed my first property in June. So as far as me being able to go into all the details of syndication and stuff like that, that's not the value that I'm bringing as far as what I've done, because I haven't done it yet, although I really, really am aiming to get there. I'm really hoping to get there, and I'm learning a lot along the way. But I happen to work with probably the largest passive investing group in the world when it comes to syndications, and that is banks. There is no greater passive investor in real estate in the country than the lenders. When a lender is giving you a loan, he's not just lending you money. The bank isn't a credit union or whatever. It's not just lending you money. They're hoping to get a return on their money. They're charging you, and just because they're hoping to get a return, and they also want to know that this is a safe investment. So what we're doing is that we're underwriting these deals for the banks. We taking your rent roll, your historical operating statements for the properties, and I'm sure you're well aware, but we do the underwriting, we double check everything, we'll hit you back with questions, and we're gonna make sure that everything checks out so that when we present it to the lenders, they have an appetite for it. That's a little bit of the basics of what I do. And being in that space of working for the biggest passive investor, I think that there's a lot of behind the scenes that I get to see of what the lenders have the appetite for, what they don't have the appetite for, what the risks are that they're seeing that the typical passive investor is not necessarily seeing, because banks have a different way of looking at it. Banks have a much different data set that they're using in order to gauge risk. So there's a lot of information, and especially from the feedbacks that we get from banks. So I'll give you an example of just something like this that a lot of people don't know. First of all, one of the things that passive investors should know is there's no asset that the banks like more to invest in than multifamily real estate.
Interesting.
So if you're a syndicator and you're talking to passive investors, or if you're a passive investor and you're looking for a safe investment, banks love multifamily. It is one of the easiest loans to get done, is a multifamily loan.
Oh,
it's considered a low-risk investment by banks. But of course, obviously, if the underwriting works out, they're going to see if this property is making money, what the potential is. etc. Another thing that the banks obviously are looking at, which I heard you talking about on one of your previous podcasts, is very important to these lenders. These passive investors, the biggest passive investor that there is in the marketplace, is the team. You were speaking about that they want to know who the team is. They're not just looking at the asset, they're looking at the team. They want a bio on anybody that is a sponsor of 20% or more in this deal. They want to know a real estate bio. What's the history of this person managing real estate? What real estate have they owned in the past? They're going to be asking for a schedule of real estate owned from each one of the sponsors. Now, you can have operators who are getting loans who are not experienced. Typically, these are going to be going to hard money loans. If they're going to a hard money lender, it's very often is because, not all the time, there's different reasons to go to hard money, but sometimes a hard money loan will have to be done because they don't necessarily have the experience. The bank didn't really want to qualify them. So now, in order for anybody to lend them money and they're getting more risk, they can do that, but they have to pay more for it. So that's why you have higher interest rates on those hard money loans. That's one item as far as who the team is. Very important. They really want to know. They want to know a lot about the team. Not a lot. They don't do some deep digging. But I want to ask you an interesting question. As a passive investor, have you ever asked the syndicator, the sponsor of the deal, for a personal financial statement?
No, I never have, but that's actually a really interesting point.
Did you ever ask them that if for whatever reason they can't pay back the money, could they cover the loan out of their own pocket?
Again, it's something LPs don't do. One of our comments often is that if, and it's probably not a great idea, but if the bank likes it, these things must have been covered. But obviously, not all banks are created equal. That is one of the ideas that if a bank approved the underwriting, now it's on us just to spot check the underwriting.
Yeah, so that's a fair assumption in a lot of cases.
Assumptions are dangerous.
Yeah, I mean, again, there's certain things that you could look at that could be kind of like hints to ask about when you see, as a sponsor, I mean, are you getting access to what the financing looks like? What type of financing did they get for this deal? What's the LTV on the deal? If they had to put a lot of money down, is it because there was a cash flow problem? So they had to they could only qualify for a smaller loan because they were debt service constraint on the cash flow. Did you ever ask a sponsor for a schedule of their previous real estate owned?
Nope.
How much real estate have you?
Usually it would be previous, transactions as far as previous syndication deals. But you're right. Most LPs aren't going to ask, their own real estate schedule. Yes.
Right. What real estate do you own currently? What real estate have you owned in the past? Banks ask, how much debt do you have on these properties? You own 10 buildings, you own 5 buildings, you own 1 million units, whatever you own. How much debt do you have on theirs? How much of it's really yours? What's your net worth and what's your debt? What's your outside debt? Outside of this syndication, what other debt is there that we don't know about? So, like I told you, having that inside perspective of what banks, the biggest passive investor in multifamily real estate in the country by far, these are their thing, the things that they're looking at, they want to know. Now, of course, if you asked an LP, right? I'm sorry, if you asked a GP, if you asked him, I'd like to see a personal financial statement.
It's how you get lost.
Yeah, that's how you get lost, exactly. But they're not telling the banks to get lost because the banks know that they know that they're going to qualify for this loan. They're going to need it. You're an investor, so you're taking a risk. Now, why is it that banks can be so pushy about the requirements for a loan? I mean, they make money off their loans. It's their business. Don't they want people to come to them? Well, obviously, you know, banks are much more risk averse than you are because you're playing with your money. Banks are playing around with their deposits.
Yeah.
Now, what do you mean? They're playing around with my money. What's happening to my money? How can they use it? So legally, they have to keep a certain amount of percentage of their deposits on hand, and they have certain lending limits that they're allowed to do in order so that they can be able to pay off the deposits should they be called. Together with the fact that there's the FDIC, which is again not so much compared to what you could theoretically have in there, obviously, as you know, but banks are extraordinarily risk averse because they're not playing with their own money, and they have to make sure that they're going to be paying back that money. So they have a tremendous amount of oversight. They're going to get audited by the FDIC as well. We were dealing with a bank. We sent them a loan, and then all of a sudden we didn't hear from them from a week. We're like, hey, Mike, what happened? We didn't hear from you. What's going on? He goes, well, we're in the middle of an audit right now. We're
Oh,
really
man.
busy. Yeah, and they have to make sure everything checks out. So banks are extraordinarily risk averse. However, because they are and they're so careful, me being on the inside talking to the banks and working with banks, it gives me a totally different perspective of what they're looking for and what they're triggering in on. There's something else very interesting that's going on in the marketplace today that it's important to know. First of all, banks are starting to get nervous. They're starting to pull back a little bit. You know, you hear it in the world, in the Twitterverse, as they call it. You hear, yeah, there's you know, prices are starting to come down. We're going to see a crash, this, that, the other thing. That's very nice. But what is the financial world really saying about it, except for the gurus online who are just saying whatever it is they want to say for fun, right?
Yeah.
So banks are starting to get a little bit wary. Sometimes they're asking for you know, a little bit of a higher LTV. They'd rather not be in at 85. They'd rather be in it. I'm sorry, at 80. They'd rather be in at 75, or they'd rather be in it at 70 because they don't want to take that risk. They want to make sure that there's enough skin in the game from the sponsor's end to keep the risk down. They'll be asking for higher ratios. So you know, and they're just being a little bit more. You know, so a little bit more. It's not a lot, a little, but you feel it. Like you hear it, you notice it. There's a little bit of concern, just a drop. Another thing that's affecting the marketplace, which is very interesting, there's a tremendous amount of multifamily construction going on now. There's a lot of new multifamily construction and a lot of other things besides new. There's a lot of repurposing going on. There's a lot of people who are taking, for example, office space that is sitting empty, and they're converting that. They're getting it on the cheap because nobody, you know, in the particular area that they're in, it's been sitting vacant since COVID. So now you have this vacant space that can use this space and turn it into a multifamily. I actually have a client right now that I'm working for. He bought an old school that was sitting vacant for a while. You know, and he's turning that into a multifamily building, right? We're doing the construction. We're working on the construction loan for him for that, right? So there's going to be a construction loan. He's going to have to convert that. But guess how much he spent for that school that he's going to be turning just for the purchase of the property? How much do you think the school? Talking about an old historic school, he's turning it into 24 units. How much do you think that school cost him?
I have no idea. I guess it would depend where it is, but you know, $1 million.
$500,000.
Wow. That's
right.
You're gonna have 24. Wow. He's doing
now
pretty
he's
well.
gonna have to do construction. The construction is gonna cost him $2 million. Okay. The construction is gonna cost him money. Don't doubt it, but it's gonna be gorgeous when it's done. And on his pro formas, he's gonna be very early on in the game. He's gonna be hitting between 1.3 or 1.35 DSCR, and he's gonna be good to go. So yes, the school construction. So I'm sorry. Yeah, so about the school construction. So he's going to spend around $2 million doing the construction, but all in,
$2.5 million, maybe $3 million after you put all the soft costs in there. You have the closing costs and you have fees and et cetera, and all the permits and stuff that he had to pull in order to get it done. But all in, he's going to be covering himself with some 1.3 starting off early on, maybe even more than that. And that's where a lot of the deals are being done. But back to my point that I was saying earlier, sorry. There is a lot of new construction in multifamily going on. In these areas where there's new construction going on, lenders are noticing that, and they're getting a little bit concerned that rents aren't going to go up as fast as they normally would once those units are complete. The saturation in the marketplace is going to go down. Demand is going to go down because there's going to be an influx of units. Vacancies might go up. So in some of these markets, I think, and I don't quote me on this, I think the last time we had this, it was one time, but it was enough to put it like to really, hit my attention. I think it was around the Phoenix area where there was a lot of construction. There was a lender that didn't want to take, and we have it all the time. We have lenders who don't want to bite on a deal, and that's fine. But we ask the reasons, what's the reason you don't want to get into this deal? They said there's way too much construction going on right here. We're not sure. So as an LP or, and you're looking at a deal, you might want to ask yourself that question and look into that is where's the construction, going right now in that area? Is there a lot of construction there? Maybe rents aren't going to pop the way they think they're going to pop. So I'm not telling you to stay away from the deal, but just have that in mind, something to think about when it comes to looking at deals in areas where there's a lot of construction.
Oh, that's a great point, because too hot can be a problem, because cyclical market is great on the upswing. And as you know, a really hot cyclical market can be brutal on the downswing. Where I'm from, Hawaii, we're more familiar with Las Vegas, and that's not the most boom bust town, but it's up there. Over the course of my lifespan, I've seen it where it's, persona non grata, nobody's moving there, nobody's investing. And, I've seen it where houses are selling like hotcakes. And, I've always been a little bit more, I'm a boring person. I'm a little more inclined to the nice, steady, boring, growth city than the boom bust city, because I don't want to play the game where, the greater fool theory, because usually you end up being the fool, not the other fool. But
never want to be the fool.
Like you would say, though, it's just good to know what you're dealing with, right? And what your capacities are. I mean, yeah, if there's too much construction in the city, clearly that is a major risk. Yes.
And yeah, the banks are looking at it that way, and it's something to be aware of.
Well, LPs should too,
What's that?
Well, definitely LPs should be looking at that too, though.
Yeah, I mean, it's interesting as an investor in real estate. One of the things that they tell us when we're looking for deals is, make your real clear criteria of what type of deal you're looking for, and then go find that type of property. And it's hard to know. And it could be, and I don't know, because I've never been an LP, but it might be something that an LP should consider also, as far as having their real clear criteria of what deals they're looking for, instead of just having deals land in their lap like, this looks interesting.
Okay. So you're talking about a buy box.
Yeah, but for the LP, not necessarily for the person who's going and looking for the deals, but having a buy box within as a limited partner, somebody who's investing. I don't know if, again, I'm not sure if that's something that limited partners do in general.
I think it's something they build up over time, but it would have been better if earlier in the process, they had that developed, so they're not just, doing shiny object syndrome. So 1 minute you're chasing a high distribution deal, and the next minute you're chasing a high value add. Because depending on your stage of lifestyle, your personality profile, all these things, certain deals are just more appropriate for different individuals, right? So if you're like me and you're a chicken, a a development deal might not be a great, fit. But then, for a person like me who's done enough deals, after a certain while, one more high distribution deal doesn't really move the needle anymore. And you go from looking at it as just a group of investments to looking at it as a portfolio. You start realizing, okay, I need to get a little out of my comfort zone. I should have a higher upside, more asymmetric risk portion of the portfolio. Now, how much of the
Right.
portfolio, that all depends on many factors, but that's one of the things I've had to tell some of the LPs, that once they've gotten to a certain scale of a number of deals or size of money, that it's not really optimal to just chase only value add or chase only distribution. You have to start looking at it geographically and return profiles, risk profiles. You're trying to build some level of diversification, even amongst the asset classes, like you had mentioned. I mean, I'm always going to look at multifamily as the bread and butter, but at a certain scale, you should be looking at storage or industrial or retail or hospitality, the different type of segments. And then, like you were saying though, the biggest thing is the team. If you're not comfortable with the team, I don't really care what the asset class is or what the pro forma says. If you're not comfortable with the team, there's a reason why banks turn deals down. You should be turning deals down as an LP too, right?
Yeah, I mean, the team is right. I mean, obviously, if banks are turning the deal down, so then banks are turning the deal down, and it's not even going to come to your table. I don't even know how it gets to your table if they haven't secured. Do you see deals that are coming to you when the financing hasn't been secured yet?
Yeah, I mean, one of the issues is they'll say they have the rate down, and I understand that rates keep moving unbelievably fast lately, but you'll say the deal is locked in, we're all fixed, we're good at 5, and then it's coming close and now it's 6, and obviously that changes the whole mathematics of the deal, and it's a credibility issue too. And I get it's been the last few months have been incredibly hard for sponsors. I mean, it's not necessarily anything nefarious. It's just rates are just blowing up. But yeah, when a deal comes across my desk and it's a low loan to value, it's like 5.5 over SOFR, no rate cap. I mean, it's just, for me, it's just I can't do that. There's enough elements of risk we're taking on. I don't really want to take on interest rate risk. And I know there's going to be smart LPs out there or GPs out there that are going to say, Andy, the Fed's only going to raise rates 1 or 2 more times. We're already in a recession. Rates are going to come back down. That's why we're doing variable. We're going to make a fortune. And that probably could even happen. Maybe it will happen. I don't need that level of variability in the portfolio. I want to look at the underwriting, and I'd rather protect the downside and look at what this is the return that we're going to do. And it could always refinance later possibly, but I to have the whole deal kind of pivoting on a refinance, that's a little too risky for my blood, at least.
I think when you're looking at a pro forma that a guy puts on your desk of what it is, so there's certain elements of a multifamily deal that a GP has control over, and there are certain elements that a GP does not have control over. I know you saw on LinkedIn, I had this post that I posted a few days ago about toilets, right? I think you like that one.
Oh, very
right?
much. Yeah.
So I had a friend of mine, this friend of mine, he got me into real estate. He was a syndicator for years. At the end of, in the middle of last year, at the peak of the market, he sold everything that he owned. He sold
Smart
a
guy.
tremendous amount of real estate. I'll just say it like that. I don't want to give out the number, but it's a big number, okay?
Good for him.
And he told me, he said, I said, he told me, he said, you can only work on the elements of a deal that are under your control. And one of the main things that are under a person's control are the management and the expenses of, like, for example, the utilities, like, again, changing to low flow toilets, which I discussed with you. I think, again, I posted that also, how if you save 25%, if you're reducing your energy or water output by 25%, you qualify for the Fannie Mae Green program and save 33 basis points on your loan if you're going through Fannie. People don't know that. There's actually companies that specialize in qualifying you for a Fannie Mae Green program loan. They'll come down, they'll make an assessment, they'll see how they can get you to that 25%. They change out all the toilets, they put aerators in the sinks, they give you the LED bulbs. And that's really a lot of the value add that happens even before you start doing the floors and the countertops and all of that. It's really, really nice. But you want to boost your NOI, cut your costs.
Yeah.
Before you're getting to the value add of, I'm going to make it like this and I'm going to increase rents. Before you increase rents, reduce your expenses. It's much easier, it's much smarter, and it's much more in your control. You don't know how high you're going to be able to bump up rents. You can speculate, and there's markets for that, and there's data, and that's true. But there's hard and fast numbers that you can use right away. Calculate the amount you're paying per gallon of water. Count the amount of gallons. I did this on my post. Count the amount of gallons per flush per toilet that you have. Count how many toilets you have. How many flushes averages per day. There's data for that online, by the way. I looked it up. What's the average amount of flushes per apartment per day? It's a lot of fun to calculate that. You should try it. Right? Go figure out how much you're paying a kilowatt per hour. If I reduce my bulbs by these amounts from this types of bulb to that type of bulb, how much are my energy savings going to be? There's ways of calculating that. You don't have to guess that. You don't have to pro forma that. You know, you look at a building, you see an old building with old light bulbs, old fixtures, old toilets, no aerators in the sinks. You don't have to change countertops. You don't have to raise rents. You can add $1 million to the value of that property if you're thinking about the NOI and how that is going to affect that is going to affect the value just by the value of the amount of income that comes in, and how you evaluate properties based on NOI. Once you reduce your cost to that amount, very easily you can really you can bring up a property's value tremendously just by something that's absolutely in your control in hard numbers. Value add is great. Don't get me wrong. There's a huge, industry of people who are doing value add by countertops, floors, appliances, you name it. Don't lose sight of the obvious things of how to increase the NOI in your property. It's right there. I don't know if people are sidestepping this, but it's a very big point. And like I said before, you can even save money on your interest rate. If you're going in like that, you could show Fannie Mae, this is how I plan on reducing the output of my energy and water by 25%. I think it has to be one or the other. I don't think you combine them. The energy and the water by 25%, 33 basis points off your loan, up to at least.
Wow.
That's a nice savings. That's a nice savings right there.
Wow.
So I lost train of thought, but
No, but it is true. In a rising rent market, people didn't need to focus on expenses, and also one of the questions was causation and correlation. Did the countertops really lead to the rent growth that the operator thinks they did, or was it just the market went up? I mean, we don't really know. It's hard to quantify.
That's a great point.
Whereas,
that's a great point.
Like if your NOI went up because of you lowered your cost, that's assuming that you're not in some bizarre city where all of a sudden water costs went down or electricity costs went down, which you and I have never really heard of a city that had a significant price break from the municipality, right? Or
for sure.
So I mean, it
happens all the time in Chicago.
Yeah, pretty clear it's a causation thing, not a correlation thing, right?
It's 100%, 100%. And the thing is that how much of the pro forma that you get in front of your desk is speculation?
Oh, quite a bit.
And assumption. And how much of it is hard, fast, calculated numbers? How much of that, right? I think you mentioned on a previous podcast, one of your guests, I think the previous guest you mentioned, I don't remember his name, I apologize, said when he sees expenses being low, like 30% in an old building, right? he gets nervous. Like, what's going on here, right? So some people will say that 30%, come on, you're crazy. This deal is a complete fabrication. Wait a second. And your guest mentioned this. Why is this expenses going down? Could be the guy has a plan about how to reduce his expenses in the way that I just described, and he has hard, fast numbers, and you ask that question, you might get a very solid answer. Now, I don't know if you're going to go from 50% to 35%, but think about it. If you can theoretically reduce your energy and water footprint by 25% within a few weeks of you being in that property by changing out the toilets and the light bulbs, okay? I'm not joking. How much is that going to reduce the expenses on the property? So a guy could look, what?
That's a great point. Of the deals I see though, and this is only anecdotal, because it's only the deals I'm seeing. Yeah, I generally see a much heavier emphasis on the top line, than cutting expenses. There are exceptions. That litmus test is just one of those. If all the deals are the same and they're top line heavy, and then
Right.
one of the biases being it's a newer operator, the first thing that they're looking at is that operating expense ratio, and they're just saying, like, is it within norm? And
Right.
unless there was a great presentation, 5-6 slides about these are all the things we're really going to do to drive down our costs in a meaningful way, it would just stand out as there's a disconnect.
Right. 100%.
I've yet to see, I shouldn't say yet, I mean, I've seen one or two, but I don't see a lot of pitch decks that really drill down into cost savings. As you know, most of them are going to be very top line heavy.
Right. What you meaning to say how they're going to add
The
value to the
revenue,
property?
yeah, the revenue line. Which, don't get me wrong, I like both. I mean, obviously you should like both, but I don't see many deals that really focus on operating efficiency. If they do, most of them it's going to be lowering a property management cost. Using technology. It depends on the industry too. Like storage is going to be very big on getting rid of all the employees and trying to automate everything with technology. It's a little different animal. But yeah, I mean, the toilets is a real popular one among multifamily operators. Some of them, not all of them, but some of them. And like you say, it depends on the building. Like if it's a relatively new building, there's not as much operating necessarily to improvements to do. If it's a 2000 building, it's different than if it's a building built in the 70s. It also depends. And did the owner renovate it over the years, or did they let it languish? Right.
Right. 100%. Right. That's a very big difference. But I think I remember now why I was getting to this, and that is you were talking about, a sponsor coming in and saying that the interest rate's going to go down. That's a lot of speculation. And when you're looking at a pro forma, right, I'm assuming you would try to say, okay, how much of this is like, how speculative is this compared to how factual it is? There's got to be a nice mix. Obviously when we're underwriting deals for our clients and we're putting it together and we're making assumptions on what rents are going to be year 3, and we're presenting this to the lenders understand that these are assumptions, but they understand their assumptions based on reality. There are certain accepted numbers of assumption, whether it be one of the easiest ones, everybody knows, a vacancy, right? Vacancy in a certain area, we assume this is going to be the vacancy over the next 5 years, right? 5% vacancy, right? Throw it in there, boom, right? Or whatever the story is. It's going to be 5%. I don't know for sure, but we have a reason. What?
No,
we have reasonable historical data that tells us that this is the average vacancy for this area, and I can rely on that it's an assumption that has a certain amount of validity to it that I feel comfortable. Me looking at your pro forma, I feel comfortable taking on that assumption together with you. I will risk my assets into your deal with that assumption because I feel comfortable that assumption is somewhat correct. For a guy to come in and say, I'm assuming interest rates are going to be going down, how do you know that? There's no way to know that.
We're flipping a coin at that point.
Right? I mean, I mean, I don't want to insult anybody, but like, buy crypto. I mean,
No, that was actually within my, within friends. I wouldn't be rude to somebody, but I said if I was that strongly believing that interest rates are, let's just say, going to go down, I would buy the inverse ETF of interest rates. I wouldn't waste my time investing in real estate. If I felt so strongly about interest rates and I knew what we were doing, I wouldn't even be investing in real estate. I'd just be specifically investing in the derivative itself.
right.
Clearly, I'm not doing because I'm not that, brilliant or
Yeah, I
arrogant.
mean, personally, for myself, I would not necessarily, like, I came along and said to me, this deal works because we're assuming interest rates are going down. I'd be like, wow, that's amazing. I wish you lots of luck with it. It sounds great. I wouldn't go that route personally. I don't know how I could feel comfortable doing that. When people ask me how they should underwrite interest rates, what should they assume the interest rate's going to be when they're closing, for example, right? They just come through with the deal right now. Yeah, we have this deal where I said, do yourself a favor, underwrite 100 basis points more than it is right now. If you're lucky, it'll go down. If not, you'll be roughly around where it should be. Underwrite high. You never know. Make the deal work with higher interest rates, because guess what? You can't lose that way. If you're underwriting down to make the deal work, then
Skinny.
it might not work. But if you're underwriting it higher than it is going to be, and then it happens to go down, guess what? You lucked out, right? But now you made your numbers work with the higher interest rates. You're at a much less level of risk compared to the reality. It's just, that's what I tell people when they call me is, what's the interest rate? Now, by the way, a lot of mortgage brokers go, oh, the interest rate, oh, it's going to be going down. Yeah, the interest is going down. You should come, you should jump in, you should refinance. It makes a lot of sense, right? No, I don't know that. Underwrite for 100 basis points higher, and hopefully it won't get there.
Yeah.
Because I mean, I'm not. It's unfortunate, sometimes in the brokerage world, people think that I'm selling a service. It's like people think I'm selling a product. Like, if I get you this loan, like, it's the best thing that ever happened to me. I got this guy a loan, and I don't care what happens to the guy, because whatever, I got him a loan, and I got my commission, and I'm happy as a clam, and leave me alone. And there you go, right? I sold the guy another loan. That's dumb, because first of all, he'll never come back to me again. Right? How much business is dependent on repeat business?
Oh,
if I just, what?
yeah, it's huge. Yeah, repeat business is huge.
Right. I mean, repeat business. And I want to do the best for my clients because I want them to come back. Aside from the fact that I would feel extraordinarily uncomfortable giving somebody bad advice personally. Oh, yeah, mortgage rates are going to come down. Yeah, blah, blah, blah. Right? Oh, well, sorry, we made a mistake. I would feel terrible if somebody happened to me. He's relying on me to make his deal work. He has people relying on him to give them a return. And now all of a sudden, I don't know why brokers have this like car salesman, and nothing against car salesmen, but they have that. Are you a car salesman?
Right, yeah. No, I mean, we saw it in, the 2007, range, where all the mortgage brokers on the residential side were, buying sports cars and then, very quickly unemployed. And
Right.
there's players that survived
Yeah.
2007 are still selling, single family home loans, and they'll be selling them in, 2030s, 2037, because they play the long game, they do everything right, and they
100%.
build
100%.
a lot of those, a lot of those mortgage brokers went into pharmaceutical sales and went into different things. And, now they're selling Beanie Babies or something. And, like I had someone say, selling is selling. And I said, oh, okay. I didn't want to say, maybe you shouldn't tell clients that, because for me, that's not something I want to hear as a prospective, client.
It's funny. For me, I look at myself as somebody who works in the real estate industry. I don't look at myself as a guy who's in sales. For me, it's like a type of networking, right? I also want to get a deal done. I also am going to want to invest, and I might want to invest with you because we work together on your loan, and I'm going to call you tomorrow and say, hey, I heard about this deal. Maybe we can get this deal together. I know that you have experience. I'm looking to partner with somebody. You've been my client for a while, and I think we would do well together. Are you interested in getting in? Is that the worst thing in the world?
Yeah, that's a good
What?
question. Yeah, no, that's awesome. No, that's awesome. That's why that's why LPs really like to meet more, people like you, because it's a different lens. We're bombarded with, the operator's lens, and, having somebody from more the credit and downside risk protection, angle is always great. You're talking about, adding on so many basis points for the loan. One of the biggest controversies, I think, within the whole underwriting process is the exit cap rate.
Okay.
And there is no good answer to this question. I mean, I'm of the opinion there really is no good answer. There's just, tell me the truth about what you do, and we'll see where we go. Because, someone could say, well, it's always been 10 basis points per year. So if you're doing 5 years from now, you just tack on 50, basis points, and you're done. And I don't particularly agree with that answer, because the past is no, indicator of future performance. The last year has been crazy compared to the last 10, 9-10 years. So that doesn't seem to make much sense. Obviously I'm not going to tell somebody, tack on 400 basis points, because that's a bit crazy and unrealistic. Where I'm kind of going with this is two parts. How many basis points would you tack on a 5-year deal? How many, and then what is your thought on just in general that, many of the things we talked about, like occupants, vacancies and things, it would be better for everybody involved if sensitivity analysis was shown of more than one, critical variance. So if you're able to say, the deal breaks even at this vacancy rate. So, at 10% vacancy, that's like our threshold of where we're going to be in deep trouble. The market's historically been 5, we're pro-forming for 5. That's where we make money.
Right.
We make a lot of money on this deal at at exiting at 6, but if it for some reason it exits at 8, we're not going to make much money. If it exits at 4, we're going to be slapping high fives, and we made a fortune. I think
you're talking about the exit cap rate from on the building, right?
Yeah, just in general sensitivity analysis, but more specifically, I think the most controversial one has been exit cap rate.
Okay, so I mean, honestly, cap rates are dependent on the market that they're in.
Mm-hmm.
Buy a property that has a high cap rate in a low cap rate area and aim for the market cap rate. That's your exit cap. Does that make sense?
Yeah, no one does that though, that I know of.
It's very simple, right? If you're trying to figure out what the exit cap should be, look at the market that you're in. What is the market cap rate? That's the cap rate for that asset. If you bought it higher, what?
I mean in 5 years.
In 5 years?
So
I don't know what the cap.
That's where it gets so nebulous, is that cap rates could be 5 right now in your market. Historically, they've been 6. So if you're buying a property at 5, and then you're looking at how we're going to sell it, obviously NOIs are great, but we are looking at, when we're calculating in our future, net present value, how are we going to look at what cap rate to use? Most people are going to say, to be conservative, we're going to tack on anywhere from 10 to 20 basis points per year, because we just don't know. Like, economy goes bad, interest rates keep going up. The floor cap in New York City, 5 years from now, we have no idea what is the general cap rate going to be, in Chicago in 4 years, 5 years. We have no idea.
I don't know. I mean, there's no way for me to know that. And honestly, that's the one thing that the passive investors that I work with, the banks, they don't care about, because they're not looking at the sale.
Yeah.
They don't get proceeds from the sale. That's not the end that they're worrying about. What are they going to get at the end from the net profit of the deal after it's sold?
The LP is definitely looking at it,
right?
Because,
okay.
Because obviously you can imagine any changes within the exit cap rate are going to have astronomical impacts on the rate, the real return that I'm making, particularly like in a value add deal. So I mean, if you're thinking like a developer or a high value add deal, most of my return is all back ended at the very, very end. And so changes in that exit cap rate are going to have tremendous impact on what return I really get. And it's been a tough question for how does anybody answer this question? Where will the world be in 5 years? I mean, nobody has a clue. We have no idea how to do this. So the general rule of thumb has always been to make the exit cap higher than the purchase cap rate, just as a measure of conservative protection. Then the argument really becomes, how much higher?
I think it's fair what you're telling me, that the practice is to add a couple of basis points to the cap rate for conservative underwriting. I think that that's a wise thing for an underwriter to do. How much it goes up over time, I don't know. I'll tell you what
for all you know, right?
I'll tell you honestly what I tell my clients when they ask me this question. I don't know. I have no idea. And if somebody asks me a question I don't know the answer to, I tell them, look, I don't know. I can ask my managing director and ask him what he thinks about it. But this is a question that I really can't answer you. I'm not going to bluff my way through it. I mean, perfectly honest with you,
I like it.
This stumps me.
Honesty. Honesty is a good answer.
Yeah, I mean, I don't know. I take responsibility for the things I tell people. Does that make sense?
Yeah, if you don't know, I don't think anybody really knows the answer to this question. So I apologize. It's kind of I don't mean for it to be a trick question or a submarine, Morty, but yeah, it's just it's one of those dirty little secrets that a lot of people don't want to talk about, and no one, including myself, really has a good answer for it. It's a difficult area. We like you said, we make the best of it we can, and we underwrite conservatively, and we're gonna go with the grace of God after that.
I'll tell you one thing that I did hear from the same guy who's telling me about the toilets originally, when he's telling me about taking control of the things that you can control instead of trying to take control of the things that you can't control. Right? You can't control the exit cap rate, and you can't control what the interest rate's going to be. You can't control that, but you can control your expenses and bring those down. Right? He told me something else, and I think that maybe an LP would benefit from hearing this. Not all your deals are going to go well. Not every deal goes well. Even for the seasoned GP, life happens, right? You're investing, and a syndication with a good with a good sponsor, with an experienced sponsor, with a good asset, with good financing, can get messed up. Stuff happens. If you diversify, you're adding a tremendous element of safety to your investment portfolio. If you're going to put all your eggs in one basket, you're setting yourself up for potential disaster, because nothing is fail safe and nothing is certain. So if, this is coming from a friend of mine who's a lot more experienced than I do, but I happen to listen to him. So I'm just going to tell you what he said.
Oh, thank you.
Diversification is very key. He told me, he said, I'm going to do 10 deals this year. One of them is going to go bad, because they don't all go good.
Yeah, that's a fair point. Yeah, that's a very fair point.
So, and by the way, and you apologize before for asking where you called submarining me on a question. I honestly appreciate the opportunity to speak to somebody and tell them I don't know, because we don't all know everything, right? But I'm pretty quick on the uptake. I love to learn, and I'll find out the answer. But I don't know everything, and certainly that question I didn't know the answer to. But and the reason for that is because it's a very hard question to answer, because nobody could really answer it. It's the same thing as speculating interest rates. We have no idea what the exit cap rate's going to be, and we don't know what the interest rate's going to be. But again, the opportunity to say I don't know is very important to me, because I don't like to pretend I know everything. It's foolhardy, and it's silly. I'm a human being. I can only know so much. Some things I know, some things I don't. Everything I could learn if I spend the time.
That's true.
And being in this industry, to be perfectly honest with you, one of the things I love about real estate it's so broad. There's so many aspects to it. There's so many different types of asset classes. There's so many different types of ways of investing in a deal. There's so many different types of ways of making money on a deal. There's just a tremendous amount of creativity, and the learning curve is really endless. I mean, how often have you, I mean, I don't know how long you've really been doing this, but when's the last time that you remember that you haven't learned something new in a long time about real estate?
Oh no, yeah, it's constant. Yeah. Every
Constant,
day,
right?
every day.
You
there's
learn new, and you
yeah.
could be shocked by new things all the time. Like, whoa, I never knew that. And I've been in this industry for a long time. And that's the beauty of it, because, you know, it's a new day every day. You're gaining something new. You can apply something new. You're meeting new people. You're being introduced to new concepts. It makes life so colorful in so many different ways. Of course, as long as you're using that to the benefit of yourself and others, and, you know, not trying to get, you know, get on the wrong side of somebody else's, you know, life. So,
Marty, what's the best way for our audience to reach you for GPs that are, you know, obviously looking for financing, or, you know, an LP that heard something, you know, really insightful and just wanted to ask you more about it? What's the best way for them to reach you?
okay, so my email address is, it's a little long. I apologize. I wish I had a shorter one, but it's mchaimovitz. My last name is Chiamovitz. So mchaimovitz, CHAIMOVITZ at meridiancapital.com. Now, there's a much easier way to get through to me, is if you check out my LinkedIn profile, you can definitely connect and send me a direct message, and I would love to respond. I respond to people all the time. Sometimes I regret it, but most of the times I don't.
That's awesome.
But I love meeting new people, talking to them just about business, just about things. If you like to just hit me up and just ask me what I'm seeing, I'm down. Let's talk. I love talking about real estate. It's a lot of fun for me. Unfortunately, I do it way too much and I get lost in it.
Oh no, man, it's awesome. No, thank you so much for, I mean, so much knowledge bombs for this CRE spotlight. It's just been outstanding, Morty. Thank you so much for coming on the show.
I
can't
really
tell you
appreciate
enough.
the opportunity.
Really
I
fun.
appreciate the opportunity. Okay, I hope so. Thank you.
Thanks, buddy.
Take care.
Thank you.
Bye-bye.